Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question for the topic non-current assets and depreciation. So you can see the question on the left hand side of your screen, and on the right hand side we have got all the workings which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. Dinesh prepares his accounts on 31 May each year. It is his policy to charge a full year's depreciation in the year of purchase but no depreciation in the year of sale. The following information relates to Dinesh's motor vehicles. So we know that the motor vehicle was purchased on the 24th of August 2013, and the original cost of this motor vehicle is $45,000. And we have 3 different financial years since we have bought the motor vehicle, and those 3 different financial years are the financial years ending 31 May 2014, 2015 and 2016. In each of these 3 different financial years, we also have different depreciation amounts, which you can see here. We have been given another statement here with regards to the disposal of the asset. So 19 April 2017, the motor vehicle was sold for $26,700 and the payment was received by check. The first question is to calculate the rate of depreciation of the motor vehicle. Now we understand that the asset was purchased on the 24th of August 2013, and we are working with a business where the financial year ends every year on 31 May. Okay, so year 1 for this asset would be from 24th of August 2013 until the end of 31 May 2014, which is 1 year. Okay, now the depreciation rate can be easily calculated by taking the depreciation expense of $9,000, which we have been given here for the first year ending 31 May 2014, and then dividing it with the original cost of $45,000, which is given here in the third column. So that gives us a depreciation rate of 20%. We want to capture the net book value as well at the end of the first year. And the net book value at any given point in time can be derived as the difference between the original cost and the total depreciation. The original cost is $45,000 and the total depreciation we have got so far is only the depreciation expense we have incurred for the first year, which is $9,000. And that gives us a net book value of $36,000 for the first year ending 31 May 2014. Now the second part of the question requires us to calculate the depreciation of the motor vehicle for the year ended 31 May 2016. So year 2 would start on 1 June 2014 and end on 31 May 2015. And we clearly understand that we are working with a depreciation method for reducing balance, because the depreciation expenses given to us in the last column shows that there has been a decline from 9,000 to 7,200 as we move from 1 year to the next. So because we're using the reducing balance method to calculate the depreciation expense in the second year and the third year, we would be multiplying the rate which we have derived with the net book value. So in year 2, the depreciation is calculated by multiplying 20% with the net book value that we had at end of year 1, which is $36,000. So 20% multiplied with $36,000 gives us $7,200 as the depreciation expense for the financial year ending 31 May 2015. Because we're using the reducing balance method, we always want to find the net book value at the end of the financial year. So which is to find the net book value at end of year 2 at 31 May 2015, which is to take the net book value that we had at the end of the first year, which is $36,000, and then subtract the depreciation expense of $7,200 for the second year, which gives us a net book value of $28,800 at the end of year 2 or at end of 31 May 2015. Now, year 3 would therefore start on 1 June 2015 and end on 31 May 2016. And in year 3, because again we're using the reducing balance method of depreciation, the depreciation expense can simply be derived by multiplying the given rate of 20 with the net book value of $28,800, which we had at end of year 2. So that gives us a depreciation expense for year 3 of $5,760. Okay? And that is the answer for part B. So question C requires us to state the method of depreciation and explain the suitability of this method of depreciation for the motor vehicle. So we already know that we have been using the reducing balance method, and we could verify this based on the depreciation, which we had 9,000 at the end of the first year, followed by 7,200 at the end of the second year, and 5,760 for year 3. So which clearly shows that the depreciation expense has been going down. So because it's a reducing balance method, how do we justify the use of this method? We are using a motor vehicle where we expect more economic benefits to be consumed by the business in the earlier years of usage of the motor vehicle. All right? And motor vehicle is a technological item, which also makes sense that we can use it as much as we can and therefore consume more economic benefits in the earlier years, because we have the passage of time and the wear and tear and the obsolescence that this asset will eventually go through. Okay? Question D. Calculate the net book value of the motor vehicle on 31 May 2016. So this is pretty easy. So we already know the net book value at the end of year 2, which is at end of 31 May 2015, and that is $28,800. And from there, we subtract the depreciation expense for year 3, which is what we derived to be 5,760, and that gives us a net book value of $23,040 on 31 May 2016. Let's answer question A. Calculate the profit or loss on the sale of the non-current asset for the year ended 31 May 2017. Now we know that we have disposed an asset on the 19th of April 2017, and we have sold that asset for $26,700, and we received the money in our bank account. All right? Now, the question also clearly mentions in the first paragraph that the business has a policy to apply a full depreciation in the year of purchase and no depreciation in the year of sale. So therefore, in the year of sale, which is the year ending 31 May 2017, we would not calculate any depreciation for this asset. Okay? That means the net book value that we will use is the net book value which we calculated at 31 May 2016 to be $23,040, right? And the disposal proceeds is $26,700, which is the money that we have received in our bank account by selling this asset. So we can see that the economic benefits available for consumption during the disposal of this asset was $23,040, but we ended up selling it for more. Therefore, we have clearly made a profit. And how much is the profit? It's the difference between $26,700 and $23,040, which is $3,660. What's question F? Prepare an extract of the income statement showing the sale of the non-current asset for the year ended 31 May 2017. Now, when we think of the income statement, what it really shows is the revenue, the cost of goods sold, other income, and all other expenses. Now, profit on the sale of non-current asset of $3,660 is a profit which we have not made from regular operations of the business, but rather it's a profit which we have made by disposing a non-current asset that the business originally owned. Therefore, this is classified as some kind of other income. So when you prepare the extract of the income statement, or when you prepare the income statement itself, you would show this profit under the other income section. And that is $3,660, which is what you have seen we have derived in the previous question. All right. So that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel. And I'll see you in the next lesson.